Most people think that cash is safe, but cash is the least safe investment. It just doesn't have the same volatility to it because we never stop creating, but is the worst investment you can do. What you find in studying history is that depressions are mostly debt and liquidity crises that are dealt with one way or another through easing a monetary policy with changes over a period of time. I describe monetary policy 1, interest rates. Monetary policy 2, print money and buy financial assets. And monetary policy 3, which we are in, is the redistributive wealth, getting money in the hands of those who wouldn't have had it through the normal financial system, essentially through that coordination. In 1944, we created a new monetary system, the Bretton Woods monetary system, and that created a bull markets and stocks and an American world order for the most part. There's a cycle that we're used to in which whenever you have an economic downturn, the central bank hits the gas and can create debt expansion. Total U.S. debt has not stopped growing since 1960, reaching nearly $31 trillion in 2022. And that produces an increase in demand, and that happens in 3 phases at the cycle. The first type of monetary policy. Normally it's interest rates. You lower interest rates, and economy turns up. The debt money is practically free. We hit 0 interest rates in debt crisis in year 1932 or more recent in the sanitary crisis in year 2020. When Federal Reserve slashes interest rates to 0 as part of wide-ranging emergency intervention. Basically, you move the interest rates up and down, and when you hit 0 interest rate, you don't have any more. You pass to the next policy. Then you go to the second type of monetary policy in which central banks print money and buy financial assets to add liquidity to economy, as occurred in the first quarter of 2020 until the middle of 2022. It is also called quantitative easing, where the central bank buys bonds from investors and they put the money received into other types of investments. It reactivates the markets. So the only other 3 times all this has happened was in 1929 in the Great Depression, 2008 in the financial crisis, and 2020 in the sanitary crisis. 0 interest rates, print money, and monetization of financial assets. That'll carry you so far, and then there's what I call monetary policy 3, which means that money does not trickle down to the population and go all the places that it's needed to go. The central bank works together with the central government to determine where the money goes. In other words, is the coordination between fiscal and monetary policy. The central bank is buying assets of a different sort, a wide range of assets producing liquidity, and also having the effect of buying government debt and monetizing it. And that's the late cycle of an expansion. That's what's driving the markets now. That's what's driving the economy now. For example, today, the Federal Reserve and the government is creating the liquidity that we're seeing in the markets, and it has big implications for the value of money. Over the last century, the purchasing power of the dollar has been steadily declining. Since the creation of the new monetary system in 1944, the dollar has lost 93% of the value. For this reason, cash is going to be a poor investment. So it's the character of the environment, which means that if you look at the returns of asset classes and you take cash, isn't it an interesting world when you have 0 or negative interest rates? It is the central bank that is making that market. So when we look at the market today, it needs the storehold of wealth, and you see it reflected in all asset classes. So that's the main driver, and it also has very big geopolitical implications. Because as we come into this environment where we have the second influence, the wealth gap and the political gap, it means that the distinction of how money and the bills are going to be divided and how that will affect tax policy, this will matter a lot. I think it's very much like the 1930s, which means it doesn't produce immediately a general level of inflation. It negates deflationary pressures. And what it does is it produces currency depreciations over a period of time. In the 1930s, all currencies depreciated at that time in relationship to gold, and so what we see is the same kind of thing happening without a general level of inflation. Not just gold, it goes into other storeholds of wealth and stocks, particularly certain types of stocks, to very much the same as 1933. In March of 1933, Franklin Roosevelt severed the connection with gold-printed money and made money available, and that was the exact bottom in the stock market. The same thing happened August 1971, when Nixon got on television and said that he is severing the relationship with gold and printing money and so on. The same thing happened in November 2012 with Mario Draghi, making the same kind of moves. And the same thing happened on April 9th when we had the moves by the US Federal Reserve and the US Congress and in Treasury. So that goes into other assets such as stocks and so on creates so reflation. It is necessary to be done because the consequences of not doing it are unacceptable. We're in a situation where every individual, every company, every government has a certain amount of revenue, a certain amount of expenses, and a certain balance sheet. And when the revenue goes down or inadequate relative to the expenses and there's not an adequate balance sheet, then defaults and restructurings take place. That's true for the population as a whole, and that's true for a number of businesses, hence the policies that we're seeing. What has been true in history is that when you have an economic downturn, a less effective monetary policies at that same time, and you have a large wealth and values gap and political gaps, you tend to have fighting internal conflict. And so rising internal conflict about how to divide the wealth pie is very, very normal historically. And so that's the dynamic I think that we're now seeing that will become manifest in changes in tax policy and so on. The investment environment going forward will be very different from the environment of the past. We will never be fully prepared for the future. The most important thing is to know how to diversify well. And what I mean by that is to go beyond just traditional mixed portfolio of stocks and bonds and to broaden that diversification. Include in that portfolio assets that might seem unusual, to include some gold, to include inflation index bonds, maybe some crypto. So think about the currency exposure. Think about safety as different. In the case of crypto, it's incredible what Bitcoin has achieved. Its popularity in the last years is going bigger, but I believe that the cryptocurrencies now will not be cash, a store of value or a medium of exchange. We'll be cashing with crypto in a portfolio. However, we are in a world in which money as we know it is in danger. Most people think that cash is safe. Cash is the least safe investment. It just doesn't have the same volatility to it because they're producing so much cash. It has a negative real return in terms of cash, so you have to think about risk differently. And you have to diversify best. That's the most important thing, to have a well-diversified portfolio to be able to face the current situation. So the uncertainties that we have today are so great in terms of all the things I mentioned, the tax policies, the geopolitical. Certainly we must experience it with the virus. Will the next wave come back? And how will it be there? Diversification can be achieved without reducing your expected returns because of the way that asset classes are priced. And then if you're going to take tactical bets, you should have highly diversified bets. Liquidity to buy assets is going to be more important than before because things change in unexpected ways, faster than ever. Don't forget to hit the like button and to subscribe and activate all the notifications of this channel. See you in the next video. Greetings and good investments.